So first on our list of stocks to have a look at this week was Adobe, which is down around 11.5% year to date. Didn't do particularly well this week, despite the earnings being pretty good. I think every time we cover Adobe, Steve, we say these are pretty good. Well, here are the numbers and see what you think. So revenue was up 10%. It was 5.71 billion in the US. EPS came in at $5.08, which was better than the consensus estimate of $4.97. About $11.4 billion of stock has been bought back in the last 12 months, Steve. And you probably might be surprised here. The market cap is $167.5 billion. I would have guessed it was a lot higher than that. So that's about 7% of that market cap bought back. In terms of a guide, they said $5.77 to $5.82 in earnings. Analysts wanted, $5.77 billion to $5.82 billion in revenue. Analysts wanted $5.8 billion. EPS of $4.95 to $5, and analysts wanted $5. So that's probably the reason it's sunk a little bit. Even though they reiterated that was a bit of a blip. They said the guide for the full year of $23.3 billion to $23.55 billion still stands, and about $15.80 to $16.10 in EPS. So the maths is 24 forward guidance, I think, and about 17 times trailing free cash flow. So I don't think that's a terrible price for Adobe at the moment. So RBC Capital Markets said investor sentiment was primarily been driven by views of Adobe's AI, which has become increasingly interconnected with concerns around competition. Morgan Stanley put out a note that said, new disclosure of Gen AI contribution is a step in the right direction, but investors need to see a clearer roadmap at the company's investor meeting at its annual conference, which I've just checked is next week. Adobe said that they generated $125 million of annual recurring revenue from the AI segment of their business in the quarter. They said that they think it'll double by the end of the fiscal year. They've been integrating this AI Firefly into Photoshop and Adobe Premiere, Premiere Pro for his video editing software. I must admit, I've had a play with Firefly, and I know Paul, who used to be on the show, was a big fan of Firefly and some of the things it could do. So Shantanu Narayan, the CEO, said Adobe is well positioned to capitalize on the acceleration of the creative economy driven by AI, and we are reaffirming our full year 2025 financial targets. They said that they're going to start charging about 50 cents per AI generated video, as well as pushing price increases across some of its applications for Creative Cloud. Steve, we've liked this one for a while because it's kind of one of the first sort of companies that's finding a way to charge for AI generation and use it in a pretty smart way, other than just being we've seen a lot of image creators and text generators, but they're fine. But the way that Firefly is kind of integrated into their products and charged for it is pretty interesting, and it works pretty well. Steve, I asked you this week, is it on your list of things to buy? And you said, actually surprised me by saying it could be. What do you think about it now?
The longer version of my answer was that everything's on my list of things to buy because everything's falling a hell of a lot at the moment. I'm just looking at it now. Adobe, one reason we've always been interested in it, or why I've always been interested in it, is as a kind of model for what tech companies look like in their final form. Over the last few years, we've seen quite a few, roughly call them SaaS companies, software as a service here, making their way in various different forms and shapes and industries and guises and doing different things. And they've all been in kind of rapid growth modes. They haven't been worried about profits. They've been investing money to try and bring on customers. But if you invest it into an intangible, effectively, it kind of shows up as a cost on your balance and your income statement. So profits have been all over the place. And that means that margins have been funny, but there is a meaningful question that you have to at least consider as an investor of, well, okay, these are not representative margins, but what do you think representative margins look like? And Adobe has been in some ways the model for if it goes kind of right, because it's got big margins, it's got huge. I was looking at their cash conversion from operating cash flow down to free cash flow, which isn't strictly cash conversion, but looking at what they have capex wise as a kind of percentage, and it's really nothing, as you might kind of expect. I'm looking at operating cash flows and free cash flows, and they are very close to the same number. It's a really nice looking business from that perspective. Balance sheet's in terrific shape, because obviously that's a very important feature when it comes to growth stocks. But it feels like an interesting time here for Adobe. It feels like they are where the next stage of AI comes from. So we've got to the point of building out data centers and setting up LLMs and training them and that kind of thing. Now, time for this to start adding value to people's actual businesses. And as is often the case, Adobe's at the kind of forefront of that curve. It seems they are getting genuine value out of AI. They are attempting to turn it into something they can meaningfully charge for. Guidance may be a bit lighter than what sort of analysts were expecting here, and in general the market has been coming lower. It bounced a bit today, but it's down about 30% over the last 12 months, which is a decent sort of a decent fall away here. And when we talk about their kind of biggish share buyback thing, it does do more than just offset kind of stock-based comp, which is a thing that we sometimes are wary of with tech companies. I mean, it ought to be doing that, because Adobe isn't a startup that doesn't have any kind of cash that it generates here, but it's bringing down its share count pretty impressively, I think, along the way, and it's been coming down steadily over the last kind of 10 years. So lots to like if you can find it at the right price and just get a proper feel for its moat. But feels like a company that's set to be relevant for quite a long time, Steve.
Yeah, I don't really see any of the competition coming along and beating it up. It did lose the Figma acquisition that hit the brakes, so that was one of the important kind of things that I was hoping Adobe would get tacked on. And the market's not been overly keen. Well, it wasn't overly keen about the Figma acquisition, but it was less keen that it got dropped off at the end, because I think it kind of didn't like the acquisition and thought it was quite expensive. Then a lot of people went and played with Figma's tools and went, actually, we're warming to this acquisition. I think this is quite good. This will be a good thing. And then Adobe, unfortunately, had to drop the acquisition because of competition. It's an interesting one to me, Steve. I think it's still the leader. I don't see anybody coming in and taking market share away from them in a real serious way for quite a while. On your point of being down about 30% in over 12 months, it's down about 30% since the middle of December. So it's had a pretty hefty fall. It's about 33% off its 12-month highs as well. So it's come down a long way. Been a real winner over the years, Steve, with some pretty large dips in the middle. I think people are just kind of waiting for this next phase of growth to come along. The products that they have now are quite mature, and this AI service that they're tacking on, if it can essentially double its revenue, this could be the next thing that comes along and continues to move those earnings higher. But I think if you wait too long, Steve, the opportunity might leave you. I think you need to have a look at it sharpish and kind of figure out if you can make it work. Because if they make the AI side of their business work and roll it out to all of their customers, I think the market will send this higher. So it's a lot of ifs and buts, I guess, but I think they're quite well positioned to do okay from here, Steve.
To your point that it's possibly a moment for having a close look at this, I'm looking at their PE ratio at the moment and where it's been over the last 5 years. I've got a chart on my screen that covers from roughly the last 5 years or so of PE. And if you think it fell quite sharply, last time it was down fair bit was in 2022, when a lot of things were. The latest drop over the last week or so has now pushed its PE ratio below where it was then. It's now just slightly below 26, and back in 22 it made it to around 27.5. So marginally below, but you are talking about those kind of not crash level necessarily, but that's lowest it's been in the last 5 years, and by some margin. This is a thing that has historically got itself up as high as 68 in some cases, and I'm not saying you should buy this on the assumption it's going back to 68 times earnings or anything of the sort. But if you think PE ratio is relevant, which for a business like Adobe, I'd say it probably is actually a reasonable way of looking at this kind of metric. It's at the lowest it's been in the last sort of 5 years or so. So maybe that's a reason to have a look at it with a bit more urgency. It can still go lower, right? Absolutely can go lower. It's got to be at its lowest point at some stage. So no guaranteeing it won't go below this, especially if earnings keep growing. But from a value perspective, I think there's probably a decent reason to take a look now. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.